The official numbers, well, they're telling us that the American economy is completely bulletproof.
Mm-hmm.
You look at the headlines, and it's just a victory lap. Unemployment's down, participation's up, and the administration is practically popping champagne.
Right.
But we need to stop looking at the press release and start looking at the price tag. Because if you really analyze where the smart money is moving right now, the story isn't growth.
No, it's exit strategy.
It is the ultimate case of cognitive dissonance. The government says, boom.
But the market is screaming bust.
And we are not here to sugarcoat this. We've gone through the latest data, the charts, and the specific alerts from Chief Market Strategist Gareth Soloway. And the conclusion is, oh, it's on and brutal. The highs for this market cycle, they are likely in. We are staring down the barrel of a 13% crash in the S&P 500.
A huge drop.
A huge drop, a Bitcoin collapse to $35,000, and a fundamental reset of the U.S. dollar.
It sounds extreme, I know. But when you strip away the emotion and just look at the raw mechanics of the market, the math doesn't really leave room for many other outcomes.
That is exactly what we're digging into today. We're going to unpack why the paper economy has completely divorced from reality, why the wealthy are quietly selling their assets while telling you to buy, and what this Liberation Day rally really was.
But first, we have to talk about that disconnect.
The payroll anomaly.
Exactly.
Right. Let's start there. Because this week, the setup was perfect for a rally. The administration spent days walking back expectations, basically whispering to Wall Street.
Hey, don't expect too much. The numbers might be soft.
Which is a classic game. You lower the bar so you can trip over it and still look like an athlete.
It is.
And then, boom, the numbers come out. And they aren't just good, they're Goldilocks. Perfect.
Right.
Unemployment inches down, participation rates beat estimates. I mean, on paper, this is the dream scenario. So logically, I'm sitting there thinking, okay, good news is good news. The market should skyrocket.
And that is the trap. If you were trading off logic, you would have bought. But look at what actually happened.
It spiked for about a millisecond.
Right. A knee-jerk algorithm spike, and then nothing.
Flat.
It went totally flat. The yields did the same thing, spiked and flattened. Now, you have to ask yourself, why? If the economy is booming, why is the bond market refusing to celebrate?
That's the million-dollar question. Why didn't we rally?
Because the market is the world's most expensive lie detector. When price action ignores perfect news, it is the collective intelligence of trillions of dollars saying, we don't believe you. The big institutional money, the pensions, the hedge funds, they are looking at those government numbers, and they're sensing that they are either fabricated or just, completely irrelevant to the actual economic stress building in the system.
It feels like validation, doesn't it? I mean, for the average person listening, trying to buy groceries or pay insurance, the economy certainly doesn't feel perfect.
Not at all.
And now, finally, Wall Street is voting with its wallet to agree with the common citizen.
It is. And that skepticism is what leads us to the S&P 500. This is where the technical warning signs stop being anomalies and start becoming, well, alarms.
Okay, let's get into the S&P, because Soloway has been tracking this massive structure of parallel channel for years now. But before we get into the chart, I want to play devil's advocate for a second. We are near all-time highs. The tech sector is still printing money. Isn't calling for a crash right now just, I don't know, being a perma-bear?
That is a fair challenge, yeah. It's easy to call for rain when it's cloudy, but calling for a storm when the sun is out is harder.
So why is this time different?
The context. This parallel channel isn't some short-term trend. It connects the panic lows of COVID in 2020, drags through the bear market of 2022, and it anchors on the Liberation tariff sell-off.
Okay, let's pause on that. Liberation Day, June 2025, just to refresh everyone's memory, that was when the major tariffs were lifted.
Right.
And the market treated that like the second coming. We saw a massive injection of liquidity and just relief.
Exactly. That was the fuel for the last 6 or 7 months. Investors felt like the shackles were off. But here is the problem. We have now hit the top of that channel. Imagine a highway that the market has been driving on for 6 years. We just slammed into the guardrail at 7,100.
The glass ceiling.
I'd say reinforced concrete is more like it. To break through that level, to enter what we call price discovery mode, where the market just flies to new highs, you need incredible momentum.
New fuel.
You need fresh fuel. But instead, the market tagged that line and stalled. It failed to break out.
And when you stall at resistance,
gravity takes over. The probability has shifted, and it's shifted heavily to the downside. Soloway's analysis suggests we aren't just looking at a dip.
Yeah.
We're looking at a correction down at the bottom of the channel.
Yeah.
And that puts us at roughly 6,100.
6,100. Let's do the math on that. We're talking about a 12 to 13% drop from the highs.
Which doesn't sound like the end of the world until you realize what that erases. That move wipes out every single dollar of gain since Liberation Day. All that euphoria from last summer.
Gone.
Gone. That is 6 to 7 months of market growth vanishing into thin air.
That is going to hurt a lot of 401ks.
Yeah.
And Soloway believes the highs are already in, like the absolute top.
That's the call. He thinks we might bounce around, maybe retest a little, but the cycle peak is set. We are now officially on the back slope of the mountain.
That is a sobering thought. But okay, if stocks are risky, the usual playbook says go to commodities.
Right.
And that brings us to silver. Because, my goodness, the silver chart lately have looked less like a commodity and more like
a meme stock. It really has. We saw rich man's gold turn into a gambler's rush.
I remember looking at the chart a few weeks ago, and it was just vertical. $20 swings intraday. It felt like everyone I knew, people who don't even trade, were suddenly asking me about silver futures.
That right there, that's the signal. Soloway calls it irrational exuberance. When an asset goes vertical, it's not because the fundamentals changed overnight. It's because emotion took the wheel. It's FOMO, fear of missing out.
Soloway had a great point about conferences. He said when you go to these financial summits and you hear people screaming price targets like silver to $500,
Yeah.
that's not analysis. That's a dinner bell for the smart money to get out.
It is the psychology of the top.
Mm-hmm.
When the crowd is euphoric, the professionals are selling to them. And now, silver is paying the price for that party.
So what's it doing now?
It is currently in digestion mode.
Yeah.
It's trapped between massive resistance at $90 to $91 and support down at 70.
It's in purgatory.
For now. But the chart is flashing a big warning sign. A bear flag.
Okay, explain that for the listener who isn't staring at candles all day. What does a bear flag actually tell us about the psychology of the buyers?
Okay, picture a flagpole. That's the sharp, sudden drop we just saw. Then picture a flag fluttering sideways in the wind. That sideways chopping movement is the flag. What it represents is applause. The sellers push the price down hard, and now the buyers are trying to step in, but they're weak.
They can't push it back up.
They can't. They're just treading water.
So they're catching their breath before getting drowned.
Essentially, yes.
Yeah.
In technical analysis, these patterns almost always resolve in the direction of the initial trend, which is down. If that flag breaks, the target isn't just a few dollars lower.
No.
We are looking at a retrace all the way down to $50 or $54.
$50? Wow. That seems incredibly low considering where we just were. Why 50? Why is that the magic number?
Soloway calls it the scene of the crime.
Okay.
You have to look at history. $50 was the all-time high way back in 1980 during the Hunt brothers era. It was the high again in 2011.
So markets have a memory.
They have a very long memory. Prices love to return to old breakout points, old ceilings, to test them as new floors. It's like the market needs to go back and check the foundation before it can build the next skyscraper.
So if it hits 50, is the bull market over? Do we sell everything?
Actually, and this is where the strategy shifts, Soloway distinguishes between trading and wealth preservation.
Okay.
As a trader, he's shorting this drop. But if silver hits $50, he becomes a massive buyer of physical metal.
Meaning he's not buying a paper contract on a screen. He's buying the actual bar to put in a safe.
Exactly. That is his pass it down to the kids money. He sees $50 as the ultimate value zone. He's not trying to flip that for a quick buck. He's buying insurance.
Insurance against what?
Against the devaluation of the currency, which is the perfect segue to the big brother, gold.
Because while silver was out partying and getting hungover, gold has been the responsible adult in the room.
That is the perfect way to put it. Gold is outperforming on a relative basis because it's a pure de-risking asset. Yeah. Silver has industrial uses. It goes into solar panels, electronics. So if the economy slows down, silver gets hit. But gold is where capital goes to hide.
So where are the battle lines for gold right now?
We are watching resistance at 5,100. That's the high from February 4th. If we can break that, we could see 5,400. But the downside support is sitting between 4,550 and 4,400.
But Soloway mentioned a level that really caught my attention. He talked about an aggressive buy zone way down at 3,500.
Yes. And this highlights the difference between an amateur and a pro. An amateur chases the price up.
Right.
A pro like Soloway says, I will wait.
Yeah.
3,500 was a previous flat top resistance level. If the market really liquidates, if we get a real panic, gold might flush down to that level. And if it does, he is ready to back up the truck.
It's all about patience. But let's talk about an asset class that has zero patience and lately zero mercy, Bitcoin.
The wealth destroyer.
It's tragic, honestly. I mean, think back to just a few months ago. The hype was deafening. You had analysts on TV screaming for $250,000 Bitcoin. It's going to the moon. It's the new standard. And Soloway stood there almost alone and said, no, it's going to crash.
And he was right. He ignored the noise and looked at the pattern. He saw a massive head and shoulders formation on the monthly chart.
We hear about head and shoulders all the time, but I want to emphasize that you said monthly chart. This isn't a little blip on a daily screen. This is a pattern that took years to build, right?
Exactly. And the bigger the time frame, the bigger the eventual crash. A head and shoulders is a pattern of exhaustion. You have the left shoulder buyers push it up, then they push it even higher, but on less volume because the smart money is secretly selling.
And then the right shoulder.
A weak attempt to rally that fails.
It's the heartbeat of a dying trend.
Perfectly said. And the scary part is the math. You measure the distance from the top of the head down to the neckline, and you project that downwards. When you run that calculation, the target isn't 60,000. It isn't 50,000.
It's $35,000.
35,000.
That is a bloodbath from the highs. That destroys portfolios.
It destroys lives, and I don't say that lightly. Soloway shared a story that really drives this home. He talked about the crypto rich. And we're not talking about college kids with $100 on an app.
No.
We're talking about the whales, the guys with the private jets.
Literally. There was an anecdote about a prominent Bitcoin enthusiast, someone who was flying high, living the dream, who just listed his private jet and his $30 million mansion for sale.
In a hurry.
In a desperate hurry. And that tells you everything. These guys were leveraged to the hilt. They believed their own hype. They thought the line would go up forever. So they borrowed against their Bitcoin to live a billionaire lifestyle.
And now that the price has turned, the margin calls are coming in.
It's the Great Gatsby ending. The party is over. The lights are on and the bill is due.
It proves that money does not equal market immunity. You can be worth $100 million on paper, but if you don't respect the risk, the market will humble you. Soloway's point is that emotion destroys wealth.
But logic preserves it.
Exactly.
So with a target of 35,000, is he saying Bitcoin is dead? Is he swearing off crypto?
No, and that's the nuance. He treats Bitcoin as a trade, not a religion.
Yeah.
He's currently nibbling, taking small amounts of these levels, 60, 70,000, just to have some skin in the game. But he is saving his real firepower. He plans to dollar cost average heavily if and when it hits that 35,000 target.
He's treating it like a distressed asset. He wants to buy it when there's blood in the streets.
Precisely. It's a small part of a diversified portfolio, not a bet the farm gamble. And that brings us to the biggest theme of this entire deep dive. We've talked about stocks, silver, gold, crypto. But there is a bigger picture here. Why is all of this happening at the same time?
The currency reset.
Yes, the US dollar. The analysis here is that we are in the middle of a global liquidity reset. The dollar is losing purchasing power at an accelerating rate. You feel it at the grocery store, but the central banks feel it on their balance sheets.
That explains the gold buying. We've seen central banks buying gold at record paces for the last 2 years. They aren't doing that to day trade, are they?
No, central banks don't day trade. They hedge. They are buying gold because they are stepping out of the line of fire. They know the current fiat system is straining under the debt load.
So they're positioning themselves
for a world where the dollar doesn't hold its value the way it used to.
And that is the chill down the spine moment for me. If the central banks, the people who literally print the money, are trading their paper for gold, why aren't we?
That is the argument. If the house is buying fire insurance, you should probably buy some too. Soloway's point is that diversification is the only safety net. If you are all in on one asset class,
right,
whether it is the S&P because you think the boom never ends, or Bitcoin because you think it's the future, you are vulnerable.
So let's bring this all together. We are looking at a market landscape that is just treacherous. The government is giving us a spreadsheet that says everything is fine, while the bond market is flashing warning lights. We have an S&P 500 hitting a concrete ceiling at 7,100 with a potential 13% drop incoming. Silver is flagging, signaling a retreat to 1980s levels.
And Bitcoin is threatening to wipe out half its value from the recent top.
It is a perfect storm. The charts are telling us that the liquidity cycle is turning over. The easy money from Liberation Day has been spent.
And now comes the hangover.
It really forces you to question your sources. We consume so much news, so much noise. But if the smart money is quietly selling their mansions and buying physical gold while the headlines tell you to buy the dip, who are you going to believe?
The chart never lies. People lie. Governments massage data. CEOs hype stocks. But the price action, that is the footprint of money. It tells you what people are actually doing, not what they are saying.
And right now, what they're doing is getting out.
They are de-risking. And the window to join them is closing.
So here's the final thought for you to chew on today. Soloway gave us 2 signals to watch. You know a top is near when you hear the 4 most dangerous words in investing. This time is different.
And we are hearing that a lot right now.
And you know a bottom is near when there is despair, when your friends stop bragging about their crypto, when nobody wants to talk about stocks at dinner.
We are definitely not at the despair phase yet. There is still too much hope, too much denial, which suggests the pain is just getting started.
Look at your portfolio today. Look at it through the lens of logic, not the emotion of the crowd. Are you prepared for a reset, or are you praying for a rally? A huge thank you to Gareth Soloway and the team at ITM Trading for the data that fueled this deep dive.
Always a pleasure to decode the charts.
And for you listening, stay skeptical, stay diversified, and keep your eyes on the levels. We'll catch you on the next deep dive.